Did you know that S&P 500 companies that paid dividends in the last decades had an average return of 8.8%, while the companies that did not had a return of 1.6%? Welcome to Smart with Money, the channel where we help you make your money work for you. Are you ready to achieve financial success? Then buckle up, because today we're diving into the world of dividend investing. By the end of this video, you'll have a step-by-step guide to go from beginner to pro in no time. So stick around, smash that like button, and if you haven't already, make sure to subscribe to our channel for more amazing financial insights. Oh, and keep watching until the end, because we've got an exciting surprise waiting for you. Before we dive in, let's talk about what dividends are. In simple terms, dividends are payments made by a company to its shareholders, typically in the form of cash or additional shares. This is a way for companies to share their profits with their investors. There are three main types of dividends you should know about. Regular dividends are the most common type and are paid out periodically, usually quarterly. Imagine if you owned shares in a company like Coca-Cola, which has been paying regular dividends for over a century. That's some sweet passive income. Special dividends, on the other hand, are one-time payments, often after a significant event, like the sale of a subsidiary or a major legal settlement. For example, back in 2004, Microsoft announced a special dividend of $3 per share, totaling a mind-blowing $32 billion payout to its shareholders. Lastly, stock dividends involve the company issuing additional shares to its shareholders instead of cash. This type of dividend can be particularly appealing to investors who want to grow their number of shares without spending extra money. When it comes to dividends, you have to pay attention to the different dates too. There are three key dates to know when it comes to dividends. Ex-Dividend Date. This is the date by which you must own the stock in order to receive the upcoming dividend. If you purchase a stock on its ex-dividend date or after, you will not receive the next dividend payment. Instead, the seller gets the dividend. Record date. This is the date when the company looks at its records to see who the shareholders of the company are. An investor must be on the company's books as a shareholder to receive the dividend. Payment date. This is the date the dividend will actually be distributed to the shareholders of the company. It's crucial to understand these dates to effectively manage your dividend investments. Dividends can be a great way to generate income, but you need to understand how they're distributed and when you need to own the stock to receive them. Alright, now that we understand what dividends are, let's talk about why dividend investing is so attractive. Passive income. Firstly, dividend investing provides a steady stream of passive income. As you might have seen in our previous videos, dividend investing is a great way to create passive income. Picture this: you're hanging out with your friends, binge-watching your favorite show on Netflix, and simultaneously, your investments are generating cash for you. How cool is that? That's the power of passive income through dividends. Compounding interest. Secondly, dividend investing allows you to benefit from compounding interest. Let's say you invest $1,000 in a stock with a 5% annual dividend yield. In the first year, you'd earn $50 in dividends. If you reinvest that $50, your investment grows to $1,050, and the next year, your dividend would be $52.50. This cycle continues, and like a snowball rolling downhill, your wealth grows over time. Less volatility. Lastly, dividend investing tends to be less risky and volatile compared to other investment strategies. Companies that consistently pay dividends are usually more established and financially stable. So, by investing in these companies, you're exposing yourself to lower risk, less price fluctuation, and hence, a more stable return on your investments. Take, for example, the fast food giant McDonald's. Despite ups and downs in the market, McDonald's has consistently paid and increased its dividends since 1976, making it a reliable choice for dividend investors. Now that we know the benefits of dividend investing, let's dive into how to choose the right dividend stocks for your portfolio. There are 4 key factors you should consider: dividend yield, payout ratio, dividend growth rate, and dividend history. Dividend yield. Dividend yield is the annual dividend payment divided by the stock's price. It tells you how much bang you're getting for your buck. Keep in mind, though, that a high dividend yield may not always be sustainable. Sometimes, a high yield could be the result of a declining stock price, which could indicate trouble for the company. So, don't be lured by an unusually high yield without doing your research. Payout ratio. Payout ratio is the percentage of a company's earnings paid out as dividends. Look for companies with a payout ratio below 75% to ensure they have room to grow and maintain their dividend payments. A lower payout ratio means the company is retaining a larger portion of its earnings, which can be used to reinvest in the business or to pay off debt. This leads to a more sustainable dividend in the long run. Dividend growth rate. Dividend growth rate is the rate at which a company's dividend payments have grown over time. A growing dividend is a sign of a healthy company and can lead to significant wealth accumulation. To illustrate this, imagine you invested in a company with a consistent 8% dividend growth rate. In just 9 years, your dividend income would double. Now that's some serious growth potential. Dividend history. Dividend history is the track record of a company's dividend payments. Consistent dividend payments over a long period indicate stability and reliability. Look for companies with a history of increasing their dividends year after year, as this demonstrates their commitment to returning value to shareholders. So, when looking for dividend stocks, make sure to look for these factors and you have a big chance of getting a good paying dividend stock. Now let's talk about building a diversified dividend portfolio. Diversification is important, as we mentioned in previous videos. Diversification helps reduce risk and ensures that you're not putting all your eggs in one basket. To achieve this, spread out your investment to different industries. Some industries are known for their dividend-paying capacity, like healthcare, utilities, telecom, consumer staples, financials, and real estate, whereas other sectors like technology are sectors that have more growth potential and hence pay out less dividend. Now, let's say you're starting with $10,000 to invest in your dividend portfolio. A simple way to diversify is to split that amount evenly across different sectors. You can use the 4 factors explained before to pick the companies. So, you could invest $2,500 in each of the 4 sectors mentioned earlier. This way, you're not overly exposed to any one sector, which can help protect your portfolio from sudden market fluctuations. Another approach to diversification is investing in dividend-focused exchange-traded funds, ETFs, or mutual funds. These funds typically invest in a basket of dividend-paying stocks, providing instant diversification with a single investment. And now for the surprise promised. As you embark on your dividend investing journey, there is one more thing you can consider, and that is Dividend Reinvestment Plans, or DRIPs. Here you reinvest your dividends through a DRIP, Dividend Reinvestment Plan. This helps you take advantage of compounding interest and grow your wealth faster. When you reinvest dividends, you're essentially buying additional shares of the company without having to spend your own money. Over time, this can lead to substantial growth in your dividend portfolio. You can access DRIPs by talking to either your broker or the company you invest in. And there you have it, your comprehensive, step-by-step guide to successful dividend investing. As promised, we've got a surprise for you in the description below. A list of our top dividend stock picks for 2023. Go check it out here in the description, it's all for free. Remember, the earlier you start, the better off you'll be. So, get started with dividend investing today, and don't forget to subscribe to Smart with Money for more financial wisdom. Until next time, stay smart and keep growing your wealth.